Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Hello and welcome. Now before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This was all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. There had been here in the past one dominant pattern over all this market that 24 weeks ago took a break on the downside. It is of course the late August 24 to late February 25 ascending triangle pattern. This pattern had the requisite combined 5+ touches and is made up from a lot of smaller patterns within it. But parts of the main pattern can still be seen on my daily chart in the top left. 24 weeks ago I laid out targets below for this pattern of a primary target down at 226 and a secondary harder to reach target down at 194. 23 weeks ago prices reached the primary target, but we kept shying away from the 200 level, enough that I chose 9 weeks ago to retire the secondary target at 194. We then started approaching that 200 level again, and I started wondering whether to reinstate that 194 target or not. This week those thoughts became moot as prices reached down on Wednesday and managed 194.25. During this time my thoughts and attention had been elsewhere, as we had other interesting patterns to look at. The first had been the bright red, once more realigned March 24 to date uptrend, currently at 194 oddly enough. This has been tested a number of times since its establishment back in late May, but it had held. However, as I said 2 weeks ago, and I quote, "We had a proper close below for the first time with a further move lower today. I'm watching this development with great interest," end of quote. This observation turned out to be most prescient, as I had said 3 weeks ago about how back then the now important purple middle time, currently at 202 3/4, of the mid-March to mid-May bearish shift pitchfork, and I quote, "runs through the bright red uptrend late next week. If there was ever a time when you could knock out 2 supports at the same time, then that would be it. So I advise caution ahead of a possible further testing on the downside," end of quote. I'd gone even further 6 weeks ago when I said, and I quote, "I'd watch this bearish shift pitchfork, especially the middle time, as we seem to be running out of time." You see, what I mean is that the middle time crosses down through the bright red uptrend in about 4 weeks. Well, that's now happened, and I continued. At the end of July, and I suspect before then, something will have to give. Add to this the pressure above from the mauve medium moving average, currently at 212.5, and the static 50% absolute Fibonacci line, and it may be that we see a test down towards the July 21 low at 197.25. Watch this space, end of quote. All this has come together 2 weeks ago, and we are seeing the follow-on move lower last week and this week, and possibly we will into weeks to come. We now have to look at the downside, and apart from the already mentioned supports, we now need to look at the March 21 low at 191 3/4, plus the purple lower time, currently at 191.25, along with congestion at 190.5. However, if these levels are breached and broken, then the very existence of the battered bright red uptrend will be at stake, as the next support is the March 2024 low itself at 187 3/4. Thus, in all this, keep an eye throughout on the bearish mauve shift pitchfork. It is running the show right now, running it lower this week, amongst others, and I will be very interested to see how next week pans out. Minneapolis wheat. The sideways action over February to May had run this market lower in mid-May, but then we saw the impact of the slightly realigned September 2019 to date uptrend. Originally way below the market, but now a lot closer. It's currently at 576, as well as the congestion below the market, but a little higher up at 578 3/4. Those together turned prices below the market. below what was at the support, but a little higher up. Sorry, those together turned prices higher in mid-May with the added impetus of a changeover gap higher at the same time. The market then rose up to the important July 23 to date downtrend, currently at 638 in mid-June, and peaked there twice. The second time in early July, a lower high, please remember I spoke about that, creating with the action a very lopsided late May to mid-July head and shoulders top. Prices had a devil of an effort to push down below the bright red neckline, which is currently at 599.5, but they eventually did in late July, though they still haven't fully let go of it. I surmise this might be a function of the steep nature of the bright red neckline. Now, I said 3 weeks ago, and it's a long quote, though it still has a number of valid points, and I quote, "In most cases, this pattern would be a bearish reversal pattern, thus a head and shoulders top. However, we do also have head and shoulders continuation patterns, a rarer pattern, but one that still exists, and right now we haven't made a confirmed break of the neckline, so I can't tell you which it would be, but I can give an idea of the size of the move once it happens. Thus, for a break lower, we would have a primary move below the neckline of 23.5 cents. A secondary hard to achieve move of 50 cents. I would add a caveat to the full move lower to watch out where the September 2016 to date uptrend is at the time, as I think that might lead to a possible higher secondary target." End of quote. Looking today, with a break below the bright red neckline, and hopefully that it isn't a false break, I can give a primary target X below in the 580 zone, with a secondary harder to reach target X1 down in the 555 zone. So how does this fit in with supports below? Well, target X is very interesting, as it is just above the historical congestion at 578.75, plus with the rising September 2019 to date uptrend currently at 576, we have a lot of support just after it might be reached, and that is without mentioning the lows in March and May this year, and also earlier in November and December last year, and in January this year as well, which are slightly higher. So you can see we have a lot of support below. However, all that's being said, we are also possibly on the threshold of a really big pattern, a December 24 to date possible cat's ears pattern. Now, for those who don't know, it's a bearish pattern. It follows on from a move down. You have a double move up, that's the cat's ears, and then a follow on lower. But for this discussion, we'll have to wait for another day and venue, as that is quite a long-term pattern to talk about. London UK feed week. Okay, so there has been on this daily chart until early July and running for about a year, one major significant pattern here, a pattern that we have not seen in the other grain markets. I still have this on my daily chart, and it is the bright red late May to early July 2024 bearish shift pitchfork. In early July, due to changeover, we had a very large gapping move higher up and out beyond the bright red upper time, which is currently at 167.25. Please remember that level, 167.25, and also the bright red upper time, as it will show up again shortly. Now, added to this upper time, we had higher, the important, even today, 50% absolute Fibonacci line at 180.5. And you had, and even now still have, an area overhead that is significant resistance, as it capped the market on its rise back in July, with some added help nearby from the purple July 23 to date downtrend. It's currently at 182.20, making a rounded top pattern. Since that peak, we have seen prices ease lower, this week down below the gold long moving average, currently 170.65, and the 50% Fibonacci line of the May 24 to July 25 move at 169.70. And finally, start to slow at the combination of the May 23 low at 168 even, the previously mentioned bright red upper time, and to a dark blue neckline extension, to a pair of very long-term patterns, which I will detail now, both currently at 168.05. So this all leads me to my final 4 points, the same 4 points I've been discussing for months now, and 3 of them was something that I noted back in my annual commentary when I did back in January on London Feed Week. To see these, it is best as we switch on my longer term over to my longer term monthly charts from these daily ones. Firstly, I saw back then the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern akin to a double top formed after a big fall such as the fall we had earlier in 2023, as well as an even longer term second pattern, an August 2022 date very large head and shoulders top pattern. These two super long-term patterns both rely on one single feature, and that is their common neckline, highlighted in purple on my monthly chart, currently at 168.05. Thus, a primary target X3 for the bearish cat's ears pattern would be down in the 127.5 zone, just below the bright red and big old 2005 to date uptrend, currently 131.55. A secondary harder to reach target X4 will be down in the 112.85 zone, around where the dark blue lower trend line is. That's currently at 113.90 for the 2007 to 2022 ascending expanding wedge pattern. For the head and shoulders top, we would have an even lower primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 200 or so charts. 1975 to date, yes, last century, also half a century old, currently at 65.95. I'm not even going to give you my secondary hard to achieve target for this pattern as it is below zero. Please remember, these are very long-term targets stretching possibly over many years, but they are still targets below for these patterns above. Now, that all being said, July with changeover threw a major spanner in the works for such long-term patterns. The reactionary immediate countering monthly key reversal up for July went back above the purple neckline but stopped at the breached early 2016 to date uptrend, currently at 179.05. The question, and it is a longer term question, is whether this is just a reactionary single month move higher or the beginning of something else. For now, as I've done in the past, I will stick to the reactionary single monthly move higher. But I am prepared to start looking at the possibility of a new base of support, not only being built but also being exploited for a possible move higher. There is one caveat to this, as we have also created since mid-2023 a big bear channel, currently 134.15 up to 182.75. Even with such a big reactionary move up, back up, we are still sitting within this bear channel, and it does have the advantage of having at least the 5 touches necessary to legitimize it. For all this, we are dealing here with, as I've said before, some very long-term patterns, and you should please bear that in mind. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.